Hello, this is Helaluddin Ahmed, and today I am going to discuss on accounting for merchandising operation. Merchandising business means buying and selling of products without involving the manufacturing process. Merchandising companies that purchase and sell directly to consumers are called retailers. Merchandising companies that sell to retailers are known as wholesalers. The primary source of revenues for merchandising companies is the sale of merchandise, often referred to simply as sales revenue or sales. A merchandising company has two categories of expenses: cost of goods sold and operating expenses. Cost of goods sold is the total cost of merchandise sold during the period. This expense is directly related to the revenue recognized from the sale of goods. The operating cycle of a merchandising company ordinarily is longer than that of a service company. The purchase of merchandise inventory and its eventual sales lengthen the cycle. The presented diagram shows the operating cycles of merchandising companies. Please note that the added asset account for a merchandising company is the inventory account. Companies report inventory as a current asset on a balance sheet. The flow of cost for a merchandising company is as follows. The beginning inventory plus the cost of goods purchased is the cost of goods available for sale. As goods are sold, they are assigned to cost of goods sold. These goods that are not sold by the end of the accounting period represent ending inventory. Companies use one of two systems to account for inventory: a perpetual inventory system or a periodic inventory system. In a perpetual inventory system, companies keep detailed record of the cost of each inventory purchase and sell. These records continuously perpetually show the inventory that should be on hand for every item. Under a perpetual inventory system, a company determines the cost of goods sold each time a sale occurs. On the other hand, in a periodic inventory system, companies do not keep detailed inventory records of the goods on hand throughout the period. Instead, they determine the cost of goods sold only at the end of the accounting period, that is, periodically. At that point, the company takes a physical inventory count to determine the cost of goods on hand. To determine the cost of goods sold under a periodic inventory system, the following steps are necessary. The first one is determine the cost of goods on hand at the beginning of the accounting period, and the second one is add to it the cost of goods purchased, and the third one is subtract the cost of goods on hand at the end of the accounting period. In case of purchasing the merchandise from the seller, there is necessary to consider the freight cost. So what is freight cost? The freight cost actually represent the cost is related to the transportation of the merchandise. The sales agreement should indicate who the seller or buyer is to pay for transporting the goods to the buyer's place of business. When a common carrier such as a railroad, trucking company or airline transport of the goods, the carrier prepares a freight bill in accord with the sales agreement. Freight times are expressed as either FOB shipping point or FOB destination. The letters FOB means free on board. Thus, FOB shipping point means that the seller places the goods free on board the carrier and the buyer pays the freight costs. On the other hand, FOB destination means that the seller places the goods free on board to the buyer's place of business and the seller pays the freight. This table shows all the summary of merchandising journal in case of sale of the merchandise and purchase of the merchandise. And that's all for now. Thank you.